You know, whenever I speak to students of the market, I like to remind them that speculation is a business, plain and simple. And like any business, you must have rules. Not loose ideas, not hopeful intentions. Rules. Today we're talking about one of the greatest of them all, sticking to your system, the iron rule that saves speculators. And before we move deeper, let me tie this to the previous video on 4 critical mistakes you're making with stock market volume analysis, because understanding volume is only half the battle. The other half is obeying what your studies tell you, without wavering. Now, you and I both know how easy it is to get pulled off course. A little excitement in the tape, a sudden jump in price, a rumor whispered on the street. Any of these can nudge a trader away from the very method he spent months building. Tell me, have you ever watched a chart you had a clear plan for, only to abandon that plan the moment the market started moving faster than your nerves could follow? That right there is the silent destroyer of trading accounts. When I talk about a system, I'm not talking about something mysterious or mechanical. I'm talking about the set of principles you have studied, tested, and proven to yourself through observation. Your way of reading the tape, your method of judging supply and demand, your rules for entering and exiting, all based on cause and effect in the market. Yet the moment a trader breaks his own rules, even once, he begins building a habit of disobedience. And in speculation, that habit becomes very costly. You must understand, the market always presents 2 forces: the movement of price and the movement of your own emotions. And if you haven't trained yourself to obey your method, which of those forces do you think will win? Ask yourself that honestly. I can tell you from decades of study, emotions will win every time unless governed by structure. Sticking to your system is not about rigidity, it's about consistency. It's about learning what should happen when supply shows itself clearly, when demand steps in with authority, when volume warns you of a trap forming, or when the character of the trend shifts. If your system calls for you to wait for confirmation and you instead jump in early, because the move looks good, you're not speculating, you're gambling. And speculation is not gambling, it is business analysis applied to the behavior of crowds. Many traders build a method they believe in, but the moment the market heats up, they forget all about it. They start trading the excitement, not the principle. But let me ask you, if your system was good enough to build, why isn't it good enough to follow? If you trusted it during study, why ignore it during action? This lack of discipline is exactly why so many lose money in markets where very few should actually lose. And here's the truth most traders won't admit. Sticking to your system is often harder than building the system in the first place. Studying charts is easy. Writing rules is easy. But when the market starts to shake, when it moves just enough to tempt you, do you have the backbone to obey your own plan? Or do you fall into the common trap of thinking, just this once, I'll make an exception? That one exception is where a trader's downfall begins. Another thing, your system is not just about setups and signals. It includes your mindset around money. A trader who fears losing will break his rules to avoid discomfort. A trader who fears missing out will break his rules to chase excitement. A trader who has not yet made peace with risk will constantly sabotage his own decisions. Have you ever noticed how some traders abandon their method right when they need it most? That's because their relationship with money, earning it, risking it, losing it, is not aligned with the calm, business-like nature required for speculation. I often tell traders to remember that the market does not owe you anything. It doesn't care about your needs, your hopes, your timetable. It will do what the law of supply and demand dictates. And if you have a system designed to identify those shifts, all you must do is obey it. That's why today's principle pairs so naturally with what we discussed in the previous video on volume mistakes. Because when you understand what volume is telling you, but you don't follow your method, you end up reading the truth while acting on impulse. Let me give you a simple picture. Imagine you've identified a clear trading range forming after a long decline. The stock shows signs of accumulation, support holds, volume expands on rallies, contracts on reactions. You've studied this pattern. You know it. You've seen it hundreds of times. Your system says, wait for the spring, wait for the test. But then the stock jumps 5 points in a day on a little news event. Suddenly you feel pressure. What if this is the move? What if I miss it? And in that moment of fear, you break your rule and chase the advance. Then what happens? The move fades. The stock pulls back. Your emotions rise. You exit at a loss. Meanwhile, if you had simply waited for your system to confirm, you would have been positioned calmly, correctly, and profitably. The market rewards the trader who keeps his head when others are losing theirs. And keeping your head is impossible without a structure you trust. Your system becomes your compass in storms. Without it, you drift. With it, you operate like a business owner, patient, deliberate, observant. But I'll ask you something important. Is your system truly yours? Or is it a collection of ideas borrowed from others, never fully tested by your own observation? Because a man will not follow a rule he does not believe in. If you have not personally proven your method through study, then you will have trouble sticking to it when the market challenges you. See, the market has a way of exposing every weakness in your character: impatience, fear, greed, indecision. Your system is not just a strategy, it is the means by which you train your own nature. Every time you obey it, you strengthen your discipline. Every time you break it, you weaken your foundation. This is why I often tell students you don't trade the market, you trade your plan. The market merely provides the canvas. Your method provides the strokes. Your job is not to outsmart the market minute by minute. It is to follow your system with such consistency that outcomes become a function of probability rather than emotion. And the longer you trade, the more you'll see that the great speculators, the ones who lasted, not the lucky ones who flashed and disappeared, were men who obeyed their own principles with near religious devotion. They didn't do it because they enjoyed discipline. They did it because they learned, often through painful experience, that without discipline, no method survives, no account survives, and no trader survives long enough to see the rewards of compound skill. Now think carefully about your own trading. Consider the last month, or even the last week. How many of your losses came from the market behaving unexpectedly, and how many came from you ignoring your own rules? The answer, for most traders, is uncomfortable, but that discomfort is exactly the point where growth begins. When we say a trading system is only as strong as your willingness to follow it under pressure, we're really talking about the heart of speculation, the part most people underestimate. Anyone can design a set of rules on a quiet Sunday afternoon, when the market is closed and emotions are calm. It's easy then to believe, I'll follow this exactly. But the real test begins when the market opens, price starts swinging, and your nerves feel every tick. That's when the true strength of your system is revealed, not by its logic on paper, but by your ability to obey it when the pressure rises. You see, a trading system is more than entries and exits. It is a disciplined structure. It's a guardrail built from your studies, your observations, your repeated experiences. But even the most robust method becomes useless the moment you step outside it. A system is like a blueprint for a building. If the builder decides midway to ignore half the instructions, the structure collapses. Have you ever had a plan that looked perfectly reasonable until the market moved against you by a small margin, and suddenly you felt the urge to override your own rule? That urge, right there, is the weakness that destroys all the strength your system was supposed to give you. A system cannot protect you from the market if you refuse to let it. Price can move fast, sure. Trends can shift unexpectedly. Volume can surge or dry up without warning. But none of that is as dangerous as the internal shift that happens when a trader decides, even for a moment, to stop listening to the rules they themselves designed. Under pressure, we find out whether the trader is running the system, or whether the market's emotional pull is running the trader. This is why traders often find themselves trapped in cycles of inconsistency. They follow the system on calm days when the tape behaves more or less as expected. Then, on the days when the market becomes a little erratic, they deviate. Just this once. But markets test you precisely at those moments. The pressure is not a side effect of trading. It is the environment in which trading actually happens. And if your system collapses in that environment, it's not because the rules are flawed. It's because the trader has not yet built the discipline to withstand the emotional heat. Think about it like this: the market is a battlefield, and your system is your strategy. You can march into battle with the most brilliant plan in the world, but if you abandon it the moment the first shot is fired, what good was the plan? A system only earns its worth when the trader proves they can cling to it through uncertainty, noise, temptation, and fear. Many traders don't lose because their system failed. They lose because they failed to follow their system during the exact moments it mattered most. And the funny thing is, the pressure rarely comes from the market itself. It comes from the trader's interpretation of it. The chart rises, and fear of missing out builds. The chart falls, and fear of losing accelerates. A small pullback feels bigger when money is on the line. A quiet consolidation feels like wasted time when emotions want action. Have you noticed how much louder your inner voice becomes the moment you enter a trade? Suddenly, every tick feels personal. Every candle feels like a message. That emotional tension is what weakens your connection to your system. To strengthen your willingness to follow your method under pressure, you must first accept that pressure will always exist. The market doesn't care about your plan, so it will not conveniently behave in ways that make your rules easy to follow. Pressure is a constant companion. The trader's duty is not to eliminate pressure, but to build a mindset capable of acting correctly in spite of it. This is where preparation becomes critical. When you know your system thoroughly, not just superficially, you build confidence in it. You understand why each rule exists, what behavior it protects you from, and what advantage it gives you over the long run. When a rule has been tested through observation and practice, it becomes more than a suggestion. It becomes a requirement. And when you respect your system as a requirement, you're far more likely to obey it even when the tape turns unpredictable. But if your system is something you only half believe in, something borrowed or copied from someone else, you'll abandon it at the first sign of stress. That's because there's no conviction behind it. You're not following something you know. You're following something you hope works. And hope has never been a reliable trading tool. Strength under pressure comes from repetition. It comes from tracking every trade, noting every emotional impulse, and reviewing where you deviated and why. Gradually, you begin to see a pattern. You notice how every significant loss traces back to a moment when you broke your own rule. You notice how the best trades were often the ones where you followed the system precisely, even when it felt uncomfortable. Over time, this pattern trains you. It sharpens your discipline. It makes you less reactive and more consistent. A system can only serve you if you serve it first. The rules you wrote are not there to restrict you. They're there to free you from chaos, from overthinking, from panic, from rash decisions. They're the structure that allows you to trade with clarity instead of confusion. But the system cannot enforce itself. It cannot force you to obey. That's your job. Emotional reactions destroy more accounts than faulty strategies, and every trader who has spent real time in the markets knows this truth far too well. You can study price action for years, you can master volume behavior, you can learn to read accumulation and distribution with near-perfect precision. But if your emotions are the ones making the decisions when money is on the line, none of that knowledge will protect you. The markets don't beat traders nearly as often as traders beat themselves. And the most destructive force is not volatility, not drawdowns, not uncertainty, but the emotional impulses that hijack clear thinking at the worst possible moments. It's remarkable how often traders blame the market for outcomes that were really caused by their own reactions. They say the stock faked them out, or the trend tricked them, or the move didn't behave the way it should. But if you look closely, most of these situations follow a familiar pattern. The chart gave signals, the tape offered clues, the structure was in place, but the trader couldn't stay calm long enough to interpret what was happening. Have you ever noticed how a chart feels completely different once you have money in the trade? The bars are the same, the volume is the same, The structure is the same, yet suddenly every tick feels heavier, every pause feels threatening, and every pullback feels like danger closing in. That feeling is not coming from the chart, it's coming from emotion. And emotion is subtle. It doesn't simply announce itself loudly. It works its way in quietly, disguising impulsiveness as logic. Fear dresses itself up as caution. Greed shows up as confidence. Impatience pretends to be intuition. Before you know it, you're making decisions that don't match your system at all, but in the moment they feel justified. Emotional reactions have a way of convincing you that you're being sensible, even when you're doing the exact opposite of what your rules require. Let's talk about fear, because fear is the emotion most traders underestimate. Fear of losing money, fear of being wrong, fear of missing out, fear of watching profit evaporate. These forms of fear drive traders to make decisions far more damaging than any single losing trade. Fear causes premature exits, poor entries, unnecessary hedges, revenge trades, and hesitation at the worst times. You might know exactly what your plan requires, yet a small pullback against your position can trigger panic that wipes out all of that clarity. Fear tells you that the market is about to reverse, even when the structure says it isn't. Fear magnifies tiny signals into major threats and blinds you to the bigger picture. Then there is greed, which often shows up when things seem to be going well. Greed convinces you to hold longer than your plan requires. It pushes you to add to a position when no setup exists. It leads you to double down because the last trade was profitable. Greed whispers, just a little more, and that one extra push often turns a perfectly good trade into a problem you never needed to have. Greed is not loud or reckless, it often appears rational. It tells you you're seeing a great opportunity, even when you're really chasing the market, because you've become emotionally attached to winning. Impatience is another account killer. Many traders enter positions not because the setup is complete, but because they can't stand waiting any longer. They want action. They want to feel involved. They want movement. But impatience leads directly into traps. It causes traders to jump early, before confirmation, before strength shows, before the market reveals its true intention. And once you're in early, your emotional tension increases, because now you're holding a position that doesn't have structural support. That tension then leads to even more emotional decision making. It becomes a spiral. And of course, there's frustration, the aftermath of losing. Frustration convinces traders they must make the money back. It triggers revenge trading, which is perhaps the most damaging emotional behavior of all. Revenge trading isn't logical. It's not strategic. It's emotional retaliation against the market, and it nearly always ends in deeper losses. If you've ever felt the urge to jump back in after a losing trade, even though no setup was present, you've felt the pull of frustration. But the real issue is not that these emotions exist. They're part of human nature. The issue is letting these emotions take the wheel. Emotional traders do not see clearly. They confuse noise for signal. They drift from plan to plan. They become reactive instead of strategic. They jump in and out of trades with no structure guiding them. And this chaotic behavior slowly drains their accounts, their confidence, and their ability to think logically about the market. This is why the strongest traders are not the most talented analysts. They are the ones who can remain calm when it matters. They've practiced discipline long enough to recognize when emotion is trying to interfere. They know the feeling of FOMO, but they don't act on it. They know the sting of losses, but they don't chase recovery through impulse. They know the thrill of winning, but they don't let a good trade inflate their confidence beyond reason. They understand that emotional stability is not a luxury in trading. It is a requirement. And here's a truth that many traders only realize after years of losses. Emotional control is part of your system. You can't separate the two. Your rules don't only dictate where to enter or exit. They dictate how you behave under stress. Your trading plan includes your mindset. Emotional reactions destroy accounts because they break the connection between the trader and their process. Without stability, even the most well-crafted system falls apart in practice. The challenge, then, is not to remove emotion. It's to prevent it from making decisions for you. And the only way to do that is through repetition, reflection, and awareness. You must review your mistakes not just mechanically, but emotionally. You must study how you felt during the trade, how your thinking changed, where the emotional trigger occurred. You must treat your reactions as part of the data, just like price and volume. Because until you understand your emotional patterns, you cannot hope to manage them. Discipline is the real edge, far greater than any indicator or pattern, and the longer you study the markets, the more clearly this truth reveals itself. Traders often believe their advantage comes from having a special chart set up, a hidden signal, or a sophisticated model that others don't see. They think the secret lies in tools, not in behavior. But if you observe the traders who survive for decades, not the ones who shine for a few months and disappear, you'll notice something striking. Their edge isn't some magic formula. It's the quiet, steady discipline that governs every decision they make. Discipline is what separates those who merely trade from those who endure. Most traders underestimate how powerful discipline actually is. They think it's a soft skill, something optional, something secondary to technical knowledge. But discipline is what makes your knowledge usable. A trader may understand supply and demand perfectly, may be able to read the tape with remarkable accuracy, may identify accumulation and distribution phases like a seasoned professional. But without discipline, those skills remain inconsistent. They come and go depending on mood, confidence, fear, or excitement. And inconsistency is one of the biggest weaknesses a trader can have. Think of discipline as the stabilizer of your entire trading process. It keeps your actions aligned with your plan. It ensures that your behavior doesn't change depending on whether you're winning, losing, or impatient. Without discipline, you might analyze the market beautifully, but still sabotage yourself through poor execution. Have you ever watched yourself violate a rule, even though you completely understood why that rule exists? It's a strange experience. You know you shouldn't do something, but you do it anyway. That gap between knowing and doing is where most traders lose. Discipline is the bridge that closes that gap. The beauty of discipline is that it doesn't rely on the market. It relies on you. You can't control where price moves, but you can control how you respond. You can't control news events, volatility spikes, or sudden shifts in sentiment, but you can control whether you stick to your rules or not. Most edges fade over time. Indicators fall out of usefulness. Market conditions evolve, but discipline stays relevant in every environment, in every market, in every cycle. It is timeless because human behavior is timeless. Discipline is also the antidote to emotional trading. Without discipline, emotions run wild. Fear pushes you out too early. Greed pushes you in too late. Hope keeps you holding losses longer than your plan allows. But discipline creates structure. It gives you a framework that guides your behavior when emotions flare. It tells you when to sit, when to act, when to exit, when to stop. The moment a trader relies on emotion rather than discipline, they move from being strategic to being reactive. And reactive traders are always at the mercy of the market's noise. You might wonder why discipline is so difficult to maintain. The answer is simple. Discipline requires you to do what is right instead of what feels comfortable. And the market rarely makes the right action feel comfortable in the moment. The right entry often feels uncertain. The right exit often feels premature. The right stop, loss feels unnecessary until it becomes the reason you're still in the game. Discipline forces you to act according to principle, not feeling. And feeling almost always opposes principle during real-time trading. The interesting thing is that discipline grows through repetition and self-observation. No trader becomes disciplined overnight. Discipline is built trade by trade, review by review. You start noticing when you break your rules, and you learn to question the impulse behind that decision. You study your tendencies. You begin to see patterns, not in the market, but in yourself. You recognize the exact moments when you tend to lose control. Maybe it's after a winning streak. Maybe it's during a losing streak. Maybe it's when you're bored or anxious or excited. The more you understand your own triggers, the more capable you become of holding firm to your rules. Discipline is also what preserves your capital during rough periods. Every trader faces drawdowns, periods when the market doesn't align with their strategy or when their reading of the tape is slightly off. Without discipline, drawdowns accelerate into disasters. But with discipline, you reduce position size, protect your capital, avoid revenge trading, and wait patiently until the conditions improve. The undisciplined trader tries to fight the market. The disciplined trader steps back, observes, and preserves strength for the next opportunity. This difference alone determines who survives long term. Another important aspect is that discipline reinforces confidence. When you know you can trust yourself to follow your plan, you trade with a clearer mind. You're not second, guessing every decision. You're not battling internal chaos. You're consistent, and consistency builds trust. You begin to see that your results aren't random. They come from structured behavior. This trust becomes a psychological edge. It gives you stability. It gives you clarity. It prevents doubt from clouding your judgment. Many traders spend years searching for the perfect strategy, yet overlook the fact that even an average strategy applied with strong discipline can outperform a brilliant strategy applied with inconsistency. The market doesn't reward brilliance as much as it rewards steadiness. A disciplined trader accumulates progress over time, slow, steady, durable progress, while the undisciplined trader experiences cycles of boom and bust. And over the long run, it's the steadiness that wins. If you examine your trading results honestly, you'll likely find that the majority of your losses didn't come from the strategy failing. They came from moments where discipline slipped. Those moments when you entered early, exited late, ignored your stop, size too big, hesitated on a valid signal, chased a move without confirmation. Each of those decisions reflects a lapse in discipline, and each lapse is a reminder that your true edge isn't on the chart, it's in your ability to control your actions regardless of what the chart is doing. When you embrace discipline as your core edge, something shifts. You stop searching for shortcuts. You stop trying to predict every tick. You stop acting out of fear. You start operating like a professional, calm, consistent, structured, deliberate. Discipline becomes your anchor in turbulent markets, your compass during uncertainty, your safeguard against emotional impulses. Breaking your rules once opens the door to breaking them repeatedly. And this is one of the most dangerous truths in trading because it happens quietly, almost invisibly. A trader rarely wakes up and decides, "Today I will abandon my system." Instead, it begins with one small exception, a tiny deviation that seems harmless in the moment. The market moves a bit differently, the setup looks almost complete, or your intuition tells you to bend a rule just this one time. But that single moment becomes the beginning of a pattern, and that pattern gradually erodes the structure that keeps your trading disciplined and consistent. The reason one broken rule is so dangerous is because it sets a psychological precedent. Once you make an exception and it doesn't immediately lead to disaster, your mind starts to justify the behavior. You begin thinking, "It worked last time," or "It's probably fine," or "I'll go back to the rules tomorrow." But the market does not punish every mistake instantly. In fact, sometimes the market even rewards bad behavior, and that's when the real trouble begins. If you break your rule and still make money, you reinforce the belief that the rule wasn't necessary in the first place. And with that reinforcement, your discipline weakens without you noticing. Have you ever taken a trade early, without confirmation, and watched it work out anyway? You felt clever, maybe even proud. But that moment didn't strengthen your method. It weakened your trust in it. Because the next time you face a similar situation, the voice inside your head won't say, "Stick to the rule." It will say, "Remember last time. You broke it and the trade worked. You can break it again." That voice becomes louder over time, and soon your system becomes more of a suggestion than a requirement. This slow unraveling is what eventually leads traders into chaos. Rules exist to protect you from the very impulses that feel wise in the moment but turn destructive over time. They guard you from emotional decisions masquerading as logic. They protect you from fear, greed, impatience, and the need for constant action. When you violate a rule, You're not just breaking a guideline. You're teaching your mind that discipline is optional. And once discipline becomes optional, your trading loses its foundation. Let's say your system requires you to place a stop loss at a specific price level, and you move it just a little, because you don't want to be stopped out prematurely. Maybe the price eventually comes back in your favor and you feel relieved. But what happened underneath that relief is far more dangerous. Your mind learned that ignoring the stop can work. So next time you move it again, maybe even further, and one day the market doesn't come back. The loss grows larger and larger, and suddenly you're sitting in a position you never would have allowed if you followed your rules. One exception created the pathway to a devastating outcome. The same applies in the opposite direction. Imagine your rules say to wait for confirmation before entering, but a stock seems to be moving quickly and you fear missing the opportunity, so you jump in early, just this once. And if the trade works, you feel validated. But the next time the market tempts you, you remember that early entry paid off before. You enter too soon again. Eventually, you catch one of those early entries on a day when the move is nothing more than noise. You get trapped in a fake out. Your confidence drops. You lose more than you expected. Yet this entire chain began with a single broken rule. This is why traders who thrive long-term treat their rules with absolute seriousness. They don't break them, because they know the cost is not measured in one trade. The cost is measured in the erosion of discipline, and once discipline is compromised, every decision becomes more vulnerable to emotional interference. The market doesn't need to defeat a trader whose discipline is already undone. They defeat themselves long before the market ever gets involved. Another reason one broken rule is so dangerous is that it disrupts your ability to analyze your performance. A good system allows you to review your trades and identify what is working and what isn't. But if you constantly break the rules, the data becomes meaningless. You can't tell whether the system is performing well or poorly, because you're not actually trading the system. You're trading a hybrid of rules and impulses, and that mixture is impossible to measure or improve. Trading becomes guesswork, results feel random, confidence fades, and once confidence is lost, discipline becomes even harder to maintain. A trader must recognize that rules are not merely tactical, they are psychological anchors. They stabilize you when the market becomes unpredictable. They help you stay calm when emotions rise. They keep you consistent when uncertainty creeps in. Breaking a rule disconnects you from that stability. And once disconnected, your trading becomes reactive instead of intentional. You might think one broken rule is harmless, especially if the trade ends well. But the consequence is always internal. Your discipline weakens quietly. Your trust in your system erodes subtly. Your relationship with consistency deteriorates slowly. Then one day you look at a loss or a series of losses and wonder how things spiraled out of control. It rarely spirals all at once. It spirals the moment you decide. It's okay to break the rule just this once, and that moment opens the door for every exception that follows.